Hello everyone, welcome to Finvest Asset Management for our first video of the year. Nicolas and I will today review 2023 and outline expectations for 2024. So 2023 was an atypical and emotionally rich year. As we saw, paradoxically, inflation was easier to predict than growth. This is what we have seen in the resilience of American growth. One important point are the central banks, and I think that we can give them credit for two elements. They announced that they were going to add and did what they had announced. Initially, there was a clear and systematic tightening through the first part of the year following 22 to curb inflation and bring it back to the 2% trajectory. Then, at the turn of autumn, a significant step was taken while waiting to see the developments that will come. Overall, central bankers have managed to bring inflation down from the figures we had at the end of 22 to much more acceptable figures by the end of 23. So, the first commendation for them is far not necessarily bringing growth to its knees. The second commendation is also a second lesson. While central banks were mainly visible in the fight against inflation during 2023, the role of ensuring financial system stability is always at work. We saw this in the case of the crisis of American banks at the end of the first quarter, where the Fed reacted with effectiveness and severity impressively to prevent a flare-up in the American banking system, or a bit later, the Bank of England with pension funds. So, we observe a year where central banks were very important in the developments observed in the financial markets and will surely be a topic again in 2024. Today, we will try to outline the perspectives we will have next year, and to start, Nicolas, what growth prospects do you imagine for the different areas in 2024?
It is tough. For 2024, we are expecting global growth to be just over 2.5%, as the effects of past monetary tightening are still being felt. There are also structural constraints in China, meaning most developed economies should grow below potential, particularly the US, which last year surprised many with higher growth, this year should slow down. This means that the growth differential between the United States and the Eurozone should be reduced by half. We had about a little more than 2% in 2023. It should go below 1%. Why? Because the US is slowing down on one side, and on the other side, the Eurozone should gently recover, and the recovery should materialize, especially in the second part of this year.
Thank you, Nicolas. Last year, we talked a lot about inflation. So, will the 2% target be reached?
Indeed. We started 2023 with inflationary fears still present, while, as expected, disinflation began during 2023. And we are now at around 3% on both sides of the Atlantic. Now, all the signs we are seeing are good, so the decline in inflation should continue, which should allow central banks to start lowering the key interest rates. We still have to monitor the more rigid components of inflation, such as service inflation and the housing component, for example, in the United States. But in our forecasts, we consider that total inflation in the US should return to around 2% this year and in the Eurozone in 2025.
So, central banks continue to roll out their plan amid an environment that is quite in line with what they expect. What are the risk factors to watch out for 2024?
That's really a good question, because everyone talks about the uncertainty around the evolution of the American economy. But there are other key factors to follow, like elections and wars. Moreover, we are in a world where balances are more complex. We are in a geopolitical, multipolar world, and therefore more difficult to manage.
Thank you, Nicolas. We see in this context that the central banks, after having significantly tightened rates and waited the necessary time for inflation to return to its target, should undoubtedly enact the first interest rate cuts to normalize policy in the spring of 2024. First for the United States and a little later, probably for the European Central Bank. The number of movement is expected to be at around 3 to 5 this year, in our central scenario trending downwards through 2024. With central bankers having successfully tackled inflation and beginning to ease their monetary condition, what will be the evolution of long-term sovereign and credit interest rates in this context? In this context of economic slowdown in the United States and likely rate slides by both, what can be expected from the bond segment starting this sovereign debt?
For interest rate markets, this year we expect rates to remain at current level. On the German 10-year bond, we have rates as of today at around 2.2%. By the end of the year, we might return to around 2.3, 2.4% with a slight increase in rates, but not necessarily significant variation as the central banks have done their job. They have tightened rates up to 4% today, and in a context where rates should decrease over the year, we think long-term rates should hold. So we could have a steepening of the yield curves with a decrease in short-term rates, 2 years or less, and long-term rates, 10 years or more, holding at these levels. However, be careful in the very short term. As we've had a significant movement in rates at the end of the year, with rates having dropped significantly on the 10 years part.
Thank you. We really liked corporate bonds in 23, both in the quality segment and in the higher yield segment. What to expect in 24?
The credit market? Yes. As you said, had a very good year in 2023, with performance above 12% for European high yield. We don't expect this asset class to do as well as in 2023 this year. However, we can estimate that credit should at least offer the carry, so the instant yield of the asset class. On high yield, since we are talking about it, we could reach between 5 and 6% this year, which would also be quite honorable in a central scenario, as we said, of a soft landing of the economy. The investment-grade credit should be around 4%. In this context, let's not forget the money market, which could also achieve a performance of around 3%.
So thank you. We see that the bond classes still bring carry in 2024. The portfolio would not be complete if we did not talk about the equity asset class. Nicolas, equity posted quite impressive performances in 2023, which was not necessarily expected. What can we now hope for 2024?
Well, it's important to remember that 2023 was exceptional. Almost all markets are at historic highs, which was not obvious to predict, especially at the time of the war in early October in the Middle East. Will it continue? We would like 2024 to be as good as 2023, but it's not necessarily obvious. It's important to remember that equity markets, in fact, evolve based on 3 parameters: interest rates, anticipated profits, and market expensiveness. If we go back to each of these 3 parameters, we hear that interest rates will not have a big impact on the evolution of the market as they are expected to remain at current levels. In terms of benefits, if we have global growth around 2.5%, we should expect almost no profit growth, at least in Europe. This means, grossly speaking, that we will have interest rates at the same level, profits at the same level. Then let's talk about valuation, because that's also very important. What's interesting and what we also saw is that we are moving towards inflation around 2%. It should be noted that between 2 and 3%, the markets, especially in the US, are valued around 20 times. So this means that today's level is not exorbitant. We always tend to think that the US markets are too expensive to be around 20 times. That's the average. When inflation is around 2, inflation must really return to that level. This means that this valuation is supporting us, especially in Europe, where we only pay about 12 times the profits of the anticipated year 2024. So, in the end, we don't expect much from the equity markets. There are also alternative classes, especially in credit, which can yield a bit more. But we are not in a programmed collapse thanks to the valuation once again. We also see that the Asian part, probably excluding China, with Japan, India, and other countries, can also be a good diversification of the equity pocket.
Now, in terms of risk factors, what you particularly be cautious about in 2024?
If we consider that there are not too many doubts about the evolution of rates, especially short rates, since we are beginning a process of rate normalization and that profits should not vary compared to the 2023 level, the risk is obviously geopolitical because it could potentially impact the prices of raw materials and oil. That's probably the main risk to follow in 2024.
Okay, thank you. So we see that 2024 opens with all asset classes having expectations of returns, which are all in the same order of magnitude. Thank you for your attention, and again, a very happy new year with Ofinvest Asset Management.